Okay, so you think Microsoft makes its money from Windows and Office. It's a reasonable belief. Microsoft has said Windows runs on more than 1.4 billion active devices. Word, Excel, and PowerPoint are the default grammar of white-collar work in almost every country on Earth. You've probably paid for a copy at some point or watched an employer pay for one on your behalf. The mental model writes itself. Microsoft makes software, people buy software, Microsoft gets rich. Here's the problem with that model. In its 2025 fiscal year, Microsoft reported about $281.7 billion in revenue. Windows licenses sold to PC manufacturers. The product the entire brand is built on sit inside a segment that Microsoft doesn't break out separately, and by any reasonable reading of the filings, they account for single digits of that total. Delete them tomorrow, and Microsoft still earns more per year than Apple makes from every iPhone on the planet. So the thing you associate with the company barely moves its accounts, which raises the obvious question: if Microsoft isn't getting rich selling you software, and it isn't, what exactly is it charging you for? The answer is that Microsoft quietly stopped being a software company decades ago and became something less glamorous and far more durable. It became a landlord. It doesn't sell products. It leases access to applications, to storage, to computing power, to identity, to the servers your employer's data physically sits on. And the lease, once signed, has a habit of renewing itself. Once you see the business that way, the strange decisions start making sense. Why Microsoft eventually gave Windows away for free. Why it barely flinched at piracy. Why it spent about $88 billion in a single year on concrete and silicon. And why the most revealing number in its accounts isn't revenue at all. It's the money already promised to Microsoft that accounting rules won't yet let it count. Strip the logo off and Microsoft is three separate companies filing one tax return. The first is the landlord in the literal sense. Microsoft owns the buildings. Server products and cloud services brought in roughly $105 billion in fiscal 2025. And for the first time, the company disclosed that Azure alone had crossed $75 billion in annual revenue, growing around 34%. That single line item is larger than the total revenue of Nike, or Coca-Cola, or Airbus. The second is the landlord in the figurative sense, and it's bigger. Microsoft 365 for organizations. By the company's own disclosures, north of 400 million paid commercial seats, the largest software subscription base ever assembled, plus around 89 million consumer subscribers. Bundle in LinkedIn and Dynamics in this cluster generated roughly $120 billion. LinkedIn is worth pausing on because it isn't really a social network. At somewhere near $17 billion a year, most of that money comes from recruiters and salespeople paying for access to a database that 1.2 billion professionals maintain for free on their own time, out of career anxiety. The users aren't the customers. They're the inventory. The third is the part you actually recognize. Windows licenses, Surface hardware, and gaming, including the $68.7 billion Activision Blizzard acquisition that closed in October 2023, the largest deal in the history of the industry. Together, somewhere near $55 billion, and the slowest growing piece of the company by a wide margin. Notice the pattern. The one division that sells you a thing you can hold and own outright is the one that's stalling. The two that simply bill you are the two that compound. But a bill is only worth something if the payer can't walk away. Think of a commercial office tower. The landlord doesn't sell you a building. He rents you square footage on a multi-year lease, bills you whether or not you turn up, and reprices at renewal. His revenue has almost nothing to do with what you actually do inside the space. Microsoft rents seats instead of square meters, and the mechanism is nearly identical. The instrument is called an enterprise agreement, a volume licensing contract, typically 3 years, generally for organizations above 500 users. You commit to a seat count upfront and pay annually. Inside, it sits a clause called the true-up. Once a year, you report how many people you've added and pay for them. There is no equivalent true-down. Higher, and the bill rises automatically. Shrink, and in most cases, you keep paying until the term expires. That structure produces a number most people have never heard of, commercial remaining performance obligation. It means revenue Microsoft has already been promised under signed contracts but hasn't delivered yet, so accounting rules forbid it from booking the money as sales. At the close of fiscal 2025, that figure stood at roughly $368 billion, more than a full year of revenue already committed, simply waiting for the calendar to catch up. And now the part that breaks ordinary business logic. For the seat business, usage barely matters. If a company licenses 10,000 employees and not one of them ever opens Excel again, Microsoft's revenue is unchanged. The person clicking in the spreadsheet isn't the customer. The customer is a procurement officer who wants one vendor, one invoice, one compliance audit, and one identity system. That's the real reason teams outran Slack. Not features, the fact that it arrived inside a contract the buyer had already signed. European regulators eventually forced Microsoft to sell Teams separately from Office, and in 2025 accepted binding commitments from the company. The bundle was that effective. It also explains the most misread decision in Microsoft's history, tolerating piracy. Bill Gates said publicly in 1998, in remarks widely reported since, that if people were going to copy software illegally, he wanted them locked into copying Microsoft's. Not generosity, tenant acquisition. And in 2015, the company went further and gave the Windows upgrade away outright. That looked like a gift. It was a change of business model. The operating system stopped being the product and became the front door. To OneDrive, to Edge, to Bing, to a Microsoft account, to a subscription. You don't charge admission to your own lobby, all of which works beautifully, right up until you have to build the buildings. Renting out cloud computing means physically owning the cloud, and that is the invisible cost sitting under Microsoft's margins. Capital expenditure ran about $28 billion in fiscal 2023. 2 years later, including finance leases, it was roughly $88 billion, double the company's entire net income from 2020, spent in 12 months on land, power, cooling, and GPUs. That is more than the annual revenue of Coca-Cola and McDonald's combined poured into buildings. Now, the part that shows how much of profit is a judgment call. Effective July 2022, Microsoft extended the assumed useful life of its server and network equipment from 4 years to 6. Nothing physically changed about the hardware, but depreciation, the accounting practice of spreading an asset's cost across the years it's expected to last, got stretched thinner across more years. Microsoft disclosed that the change would increase fiscal 2023 operating income by about $3.7 billion, entirely legal, disclosed in the filings, and a reminder that several billion dollars of reported profit rested on an assumption about how fast a server wears out. Those assumptions come due. Depreciation is now a rising fixed cost that arrives every quarter, whether demand shows up or not, and it doesn't renegotiate. In fiscal 2025, Microsoft earned around $102 billion in net income and spent nearly as much again building the capacity to keep earning it. Microsoft Cloud gross margins drifted from around 72% towards 68% over the same stretch. So Microsoft did what any landlord does when a construction cycle starts to look frightening. It rented capacity from someone else and let that someone else carry the debt. That someone else was called CoreWeave. CoreWeave started life in 2017 as an Ethereum mining operation run by commodities traders. After the crypto crash, it pivoted, repurposing its GPUs into a rentable AI cloud. The timing was extraordinary. Revenue went from $228.9 million in 2023 to $1.92 billion in 2024, an eightfold jump in a single year. Almost all of it came from one place. Microsoft accounted for roughly 62% of CoreWeave's 2024 revenue. To buy the chips, CoreWeave borrowed against them, pledging the GPUs and the customer contracts themselves as collateral, carrying around $8 billion of debt by the time it filed to go public. Net loss for 2024, $863 million. The first warning came in March 2025, when the Financial Times reported that Microsoft had walked away from some agreements and let certain options lapse. Microsoft's response was that its plans hadn't changed in any way that affected its ability to serve customers. Investors read it differently. The IPO priced at $40 a share, below the 47 to 55 range, raising $1.5 billion instead of the hoped-for $2.7 billion. Days later, OpenAI signed a contract with CoreWeave reported at up to $11.9 billion, and the stock recovered violently. What it proves isn't really about CoreWeave. Microsoft's landlord model doesn't just rent out computing, it rents out the risk of owning it. Someone else signs for the debt, someone else eats the interest, and Microsoft keeps the option to change its mind. When your biggest customer is also the party you built your balance sheet around, leverage isn't a strategy, it's a timer. The second case runs the other direction. Microsoft losing, badly, the one time it had to win on merit. Nokia had been the world's largest handset maker for 14 consecutive years. In February 2011, its new CEO, Stephen Elop, recruited from Microsoft, circulated an internal memo describing the company as standing on a burning platform and bet all of it exclusively on Windows Phone. It half worked. The Lumia 520 became the best-selling Windows Phone ever built, and market trackers recorded double-digit share in several European markets at the peak. Globally, Windows Phone never cleared roughly 3%. The warning sign was structural, and it was visible from the start. Developers wouldn't build apps for 3%, and consumers wouldn't buy phones without apps. Each reinforced the other. Microsoft's answer was to buy the problem, announcing a $7.2 billion purchase of Nokia's devices business in September 2013, closing it in April 2014. 15 months later, in July 2015, Microsoft wrote off $7.6 billion, more than it had paid. It cut 7,800 jobs. The feature phone remnant went to Foxconn and HMD for $350 million in 2016. What it proves, Microsoft's power was never persuasion. Placed on a shelf next to an iPhone, with no contract behind it, it lost. Its power is that your employer already signed. Run the optimistic case. Copilot sells at $30 per user per month on top of existing licenses. Attach it to just 10% of a 400 million seat base, and that's roughly $14 billion a year of high-margin revenue. Bolted on to contracts already signed, sold by a sales force already paid for. That arithmetic is the entire justification for $88 billion of concrete. Run the realistic negative case. Attach rates come in at 3% instead of 10%, around $4 billion, against an annual construction bill more than 20 times that size. Depreciation from the build-out arrives on schedule regardless. Cloud gross margins settle into the low 60s. Growth decays toward the pace of global corporate their IT budgets, call it 5%, which on $281 billion is still $14 billion of new revenue a year. But bought with buildings instead of a signature, enormously profitable, no longer a compounding machine. Collapse the whole thing into one line. Microsoft's engine is contracted seats, multiplied by annual price, multiplied by renewal rate, minus the cost of the buildings required to honor the promise. At $281.7 billion of revenue and roughly $102 billion of net income, that's a net margin near 36%. At that scale, close to unprecedented. The man who understood it best was Steve Ballmer, mocked for laughing at the iPhone, who never wrote the important code and simply sold the leases. His fortune, widely estimated well north of $100 billion, came from the annuity, not the invention. Which brings us to the second gap. The first gap in this video was between what Microsoft appears to be and what it is. The second is between what the business earns and what the market pays for it. A share price isn't a report card on last year's profits. It's a bet on an assumption about the future. Microsoft is traded in the multiple trillions against roughly $100 billion of annual profit, meaning buyers are paying somewhere in the region of 30-odd years of today's earnings. The assumption priced in is simple. The lease keeps renewing at a higher rate, more or less forever, and the buildings pay for themselves. What would have to break is exactly what broke for Nokia and nearly broke CoreWeave. The new features never get attached, or a rival makes the toll optional. This is an explainer, not financial advice. Microsoft doesn't sell you software. It rents you the floor you're standing on, bills your employer annually, and quietly raises the rent at renewal. And nobody in that arrangement ever got rich from typing.